Welcome to Investing Insights. I'm your host, Ivana Hampton. The chase for higher equity yields with lower risk is boosting the popularity of covered call ETFs. More than $100 billion have flowed into the funds over the last 3 years, according to Morningstar data. Covered call ETFs produce higher income, but it comes at a cost. Retirees and other income investors need to be aware of the trade-offs they're making forward. Joining me is Dan Sotiroff, a senior manager research analyst for Morningstar Research Services. The editor of Morningstar's ETF Investor newsletter is here to explain the risks and rewards of covered call ETFs. Good to see you, Dan.
It's good to see you too, Ivana.
Well, let's start. What are covered call ETFs and how do they work?
Yeah, covered calls aren't really anything new. This is a strategy that's been used by a lot of traders in the options markets for decades now. They're relatively new to ETFs. So in the past decade, we've sort of seen them slowly roll out. In the past 5 years, we've really seen a lot of them hit the market. So what are they exactly? The strategy basically consists of owning an underlying asset. That could be a single stock. It could be an index like the S&P 500 index or NASDAQ 100, excuse me. And then you're writing or selling a call option on top of that asset that you own. The option works a lot like an insurance contract, and that's the important thing to remember here. So you're selling that contract to another trader, and they're going to pay you a premium to get access to that contract, right? And that's where the income is coming from. It's from that premium payment that you're collecting. However, like an insurance contract, you're obligated to pay out if a certain event triggers. In this case, in the case of a call option, if the price of that underlying asset reaches a certain level or goes above that level, you have to pay out to that other trader that bought the contract. So in a short way, that's kind of how these are working, right? It's not too complicated at the end of the day, but that's the gist of it.
That's a great example. Thank you for that. So why are retirees and other income investors drawn to these ETFs? What's making them so popular in
Yeah,
2025?
it's really an income story, right? Like you look at the yields on some of these, and that's what's really attracting people a lot. In the past, it was always like bond funds, and then bond yields went to zero when we were in the zero interest rate environment in the 2010s. Then it was dividend funds were all the rage for a while because the yields were higher on those, so people chased after those. Now it's covered call or option income strategies right now because the yields are incrementally higher above those dividend funds or those bond funds that we have right now. So it's really what the story is. It's people are just chasing after the income or the yield.
Now, you just mentioned that the yields are very high. What's driving that?
Yeah, it's the premiums from those option contracts, just by the way they work and what the premiums actually, cost. They're a lot higher than what you're going to get out of a dividend fund or a bond fund today. So that's really what it boils down to. There's a couple caveats with that though. Those premiums change over time, so they're not static. So the yield that you get from these ETFs could change by a lot. If you want a really good example, we'll look at the trailing 12-month yield on JP Morgan Equity Premium Income ETF. The ticker is JEPI. It's one of the more popular option income ETFs out there right now. The 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 trailing 12-month yield on that ETF has landed somewhere between 6.5% and 12% over the last 5 years. It was launched in 2020, so we have about a 5-year history. So it gives us a pretty good idea. But still, like you're going from 12% down to 6.5%. Like it's basically almost getting cut in half, right? Or it's doubling from 6 to up to 12. So you can see some pretty big swings in the income that you're getting from some of these ETFs. The other thing, along those lines is that the premiums are tied to the volatility of the underlying asset, and that's why they swing so much. So as the asset gets more volatile, the premiums are going to go up and the yield is going to go up. But as the asset gets more stable, the premiums are going to go down. So that's just something to be aware of as you're getting into these things. Is it may not be reliable, but it's going to be higher than what you get out of a dividend fund.
What types of trade-offs are investors making?
There's several. First is that the income just doesn't magically appear out of nowhere, right? There is a transaction taking place in the background. And really what you're giving up is you're giving up the long-term growth of the underlying asset. You're basically trading tomorrow's price appreciation for income today is the way I sort of think about it. So you're not getting the growth of the underlying asset plus all this additional income. It doesn't work that way, right? So you're earning that income from the option premium, but the option essentially is adding a cap on that underlying asset on how high it can grow. And that's basically the mechanism that's at work here. And because of that cap, the total return on your covered call ETF is more than likely not going to outperform the underlying asset. You're inserting some additional friction into the picture, and you're more than likely going to underperform. So bottom line, if I'm looking at this as an investor, these don't make for great long-term investments. If I'm young and I've got the risk tolerance and everything like that, you're better off just being in sort of a low-cost S&P 500 ETF or something like that, right? Where most of your gains are going to be price appreciation, and it's going to be a little bit riskier. So that's the really big thing I think that most people should take away. These are not great long-term investments if you're in that accumulation phase of your financial plan in life.
Now, ETFs are known to be tax efficient investments. What are tax considerations for cover call ETFs?
Oh, there's some huge tax consequences here. So ETFs are considered tax efficient because they defer capital gains, right? That's the taxes that owed on price appreciation. They don't really have a great way. They don't really have any way of getting rid of the taxes owed on income. And covered call ETFs are all about generating income, right? So they kind of bypass a lot of the advantages of the ETF vehicle. You're going to forego a lot of those tax benefits, in other words. The income is also going to be taxed a little bit different way. So when you look at option premiums are actually subject to Section 1256 of the IRS tax code. So you're on that in that code, you're paying 60% long-term capital gains and 40% ordinary income tax rates on that. So it's a little bit more complicated. You may have a little bit more complexity come tax time if you are using some of these. So there are some out there that kind of navigate that a little bit better than others, but in general, it's a little bit more complicated tax picture if you're using these ETFs.
Let me follow up this. Should an investor hold a cover call ETF in a taxable account or a tax deferred account?
It's a great question because most of the total return is coming from income. You should really be in a tax deferred account. Like that's sort of the catch with this, right? And again, like I know a lot of people are using these for income, so they're probably putting them in a taxable account. But it's like it's how do you know? I don't. Yeah, it's a great question. They really belong in a tax deferred account. And I think like the other thing you're going to get at here is like what's optimal. Like if you had everything available to you, where would you put these? Tax-free account like a Roth IRA would be ideal because then you don't owe any taxes on the income that you're collecting at the end of the day. So sorry to jump ahead on one of your questions there.
No, that's okay. That's okay. I heard the word optimal and I was like, that's our buzzword for today. So let's jump into what's been the performance of cover call ETFs in 2025.
Yeah, it's a great question. It's really all over the place. So I think we have somewhere in the neighborhood of 150 to 170 ETFs and mutual funds in the derivative income category where a lot of these covered call strategies sort of sit. The returns are all over the place. So the best performing one was up 50% through the first 6 months of 2025. The worst performing one was down 40% over the first 6 months. And the reason for that is the underlying assets in all of these ETFs and mutual funds are different. Some of them are single stocks, some of them are the S&P 500, some of them NASDAQ 100, and then there's all sorts of other permutations and whatnot. And then the actual options overlay varies between them all as well. So there's all different sorts of combinations of options and underlying assets that you can put together. And that's why you've seen such a wide spread and wide dispersion across the board. The fees are also wildly different too. So some are charging really low fees, which we love. Some are charging, upwards of 1% or 2% a year. So you really kind of have to be careful when you're looking at this. If you want to put this in the context, if you had like a low-cost S&P 500 ETF like you would get from iShares or Vanguard that's charging 3 basis points, that beat about 68% of the ETFs and mutual funds in the derivative income Morningstar category. So it kind of shows you what you're up against. A lot of these things are probably going to underperform just a basic, market index fund over the short term and more than likely over the long term as well.
When you say these percentages, it makes me think of theme park rides where you're going up and down,
Yes,
up and down.
that's a great analogy. Yeah, it's a very good visual for sure.
Well, we've talked about different funds. Which cover call ETFs do Morningstar analysts consider a solid choice for investors and why?
Yeah, there's one that we really go back to, and it's one we've actually rated in-house already. So that's JP Morgan Equity Premium Income ETF. We referred to it kind of before. The ticker is JEPI. It's very well known within sort of the covered call, ecosystem. It's one of the biggest ETFs or covered call ETFs out there right now. We have a bronze medalist rating on it at the time. Sort of getting back to that price point, the expense ratio is 35 basis points. That's cheaper than about 92% of the covered call ETFs or the ETFs in the derivative income category right now. So we love that it's a relatively low fee compared to other options out there. And fees matter a lot in whatever you're looking at. So that's huge. There's a few other things sort of around the margins that we really like. That manager name on this fund is Hamilton Reiner at JP Morgan. And we think he does a few things at the margins that are really good. He builds the strategy around S&P 500 stocks. So these are big liquid stocks. It's a diversified portfolio. So you're not going after the single stock ETF that's going to subject you to all this, crazy risk of a single stock. And then he's very aware that you are sort of exposed to the full downside of those stocks. So he does build a sort of defensive stock portfolio from those stocks, which is one thing we like. He also sells slightly out of the money call options. And he does that to kind of preserve a little bit more of the index's upside because he knows the option is going to cap that upside, right? So he's trying to give you a little bit more incremental return from the price appreciation there. So he's aware of all that type of stuff. And then the other thing he does that's a little bit different is he sort of eases the tax burden on people. He doesn't use call options directly. He uses something called an equity-linked note, which is, we're not going to get into the details on that. Basically, what it does is it gives him exposure to the profits of the call options without owning the call options directly. And the consequence of that is that the income is going to be taxed as ordinary income. You're not going to have to deal with the goofy 1256 contracts or anything like that, or that 60-40 split. The downside is it's all going to be taxed as ordinary income. A portion of that isn't going to be taxed at a long term. So you're on the hook for a little bit higher tax bill maybe with this structure, but it's going to be a lot easier for you to manage in your taxes. So there's a little bit of a trade-off there. But all those things together, along with the lower fee, we think that's probably one of the better strategies out there right now.
You saved yourself because I was going to ask you about what is it? Equity linked note. I was going to ask you.
Yeah, it's a mouthful. It's a little more complicated. That's a little bit more advanced topic for another day.
All right. Well, thank you, Dan, for coming to the table
You're very welcome.
discussing what we all need to know about cover call ETFs.
Thank you.
That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you. And subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to motion graphic designer Daryl Lannert and associate multimedia editor Jessica Bebo. I'm Ivana Hampton, lead multimedia editor at Morningstar. Take care.